Let's welcome first Sunday of the month, Mike Muller, head of Vitol in Asia. Mike, nice to have you back. You're earning your big bucks now, I'd say. How are you reading the markets at the end of the quarter? What would be your kind of summary of quarter review, quarter behind us?
Yes, I was just looking. We started the quarter at $78 Brent. It seems that seems a long distant memory, of course. It was again another eventful week when the shift of attention definitely swung towards concerns on the demand side, and the very big numbers put out in terms of the Biden administration's resolve to give a big political message by way of an additional SPR release of 180 million barrels. And whilst there's no historic precedent of oil ever being released at a pace that the Biden administration says they want to release it, it is nonetheless a very big number, and that served the purpose as intended, I guess. But on the other side of the world, we have over here in China, lockdowns of the western half of Shanghai in force right now. And the case count in China is, by Chinese standards, a very high number. By global standards, it's negligible, of course. But they really want to eradicate this. And I think whilst the experts in the East believe that China will stay on top of the pandemic issues, I don't think financial markets in the West have quite the same view. So a combination of those two things really rubbed out any concerns over supply shortages in terms of losses out of Russia and other potential concerns on flat price, which therefore gave the markets reason to sell off $10 a barrel on Monday, from 119 to 109 or thereabouts. And then on Tuesday, we rose to 115. This is all Brent, and then finished at 105. And of course, in the final trading day of the week on April the 1st, we switched to the next nearby month because May Brent went off the screen, and June ended as low as 102. So there's one of your headlines, biggest ever sell-off in a week, from 119 to 102 or thereabouts. WTI is open now, trading at 99.20 something. So that puts Brent more like maybe 104, 105, I guess, but it remains to be seen what the WTI Brent does. But yes, it's a week when the market decided that lower was right. And of course, the other thing that people are talking about a lot is the impact on demand of the various recessionary threats and inflationary threats that we're seeing. And on that note, I'll hand back.
Yeah, Mike, sorry, the line dropped on me there. I just wanted to quickly follow up. I mean, of surprises of the quarter, I would have to say the surprise of the quarter to me is that oil prices are not really that high from the relative sense of the context. Two of the world's two biggest oil exporters caught in conflict, whether it be the Saudis with the Yemen challenge, which obviously is increasingly becoming very apparent, and of course a major war in the Ukraine. And yet, while the initial spike in oil prices, ultimately they've settled down, and from a sort of historical comparison to 2010 to 14 or any other period of dramatic comparable in history, you'd have to say at 100 to 110, it's fairly calm. Your thoughts? Volatile but calm.
Yes, just to answer quickly, I think in any other time, the attacks by the Houthis, where they successfully managed to hit some oil storage infrastructure close to Jeddah, where the Formula One race happened to be happening the next day, would have been top news, but it didn't even make the front page given everything else that's going on in the world. You're quite right. I think there is a large number of people that do feel that oil prices could be higher, considering the current risk of disruption to supplies from Russia due to sanctions. But people are still lost figuring out those numbers. I mean, the big fundamental stock draw hasn't changed. OPEC, once again, met for a very short period. It wasn't 13 minutes, it was maybe half an hour this time round, and decided to effectively roll over with a figure of 0.4 million barrels per day or so. And as such, the underlying stock draw in the market is still intact, minus, of course, the impact of COVID on China, minus the impact of what are higher than recent prices on demand, and a certain amount of rationing behavior that's going on in various parts of the world. So I would agree that given the entire price set out there, if you take a view that we're going to lose 1, 2, 3 million barrels a day of oil supply coming out of Russia, that $102, or let's just look at the number we can see in print, the $99.27 I'm seeing on WTI, does feel cheaper than most would have predicted. Yes.
Let's order the last month, the last week, perhaps even, seemed to be a battle between concerns about demand destruction versus concerns about supply shortage. Where do you think, Mike, we end the first quarter, with those two competing narratives as you sit at your desk every day to put some dollars on the line, so to speak? Are we in a demand destruction concerned weighted market, or are we still, and obviously from the US government point of view, it's a supply shortage one, because they've just announced a bionic 180 million barrels of SPR release.
Bionic. Yes, Sean, and a lot of the numbers are still rather ill-defined. So the big headline number, of course, is how much supply loss will there be due to official and self-imposed sanctions on supplies of Russian oil. And depending on which consultant, which expert you talk to, you're getting numbers somewhere north of 2 million barrels per day, perhaps, for the latter half of Q2 and into Q3. On top of that, there was a global stock draw that people were predicting on the basis that OPEC Plus continued to hold their line, not least because there's very little extra production available out of anywhere other than core OPEC these days. So that makes it 2 point something plus whatever shortfall there was arising from that. So where do we get that volume back? Well, everyone was expecting a return of Iranian supplies. I think nobody believes that's going to happen in Q2, and it looks much less likely than it did a few weeks back for various reasons. So that's still a zero. And it's quite important because the Iranians do have a lot of floating inventory, which is available to market immediately. Then we're given the SPR. Despite the big numbers, the Americans have essentially now signaled releases of 50, then 30, then 180 million barrels. That takes them right down to their 90-day mandatory stock holding, if you consider their net imports about 3.5 or thereabouts million barrels per day. So they need to stop at about 300 million barrels, otherwise they're below the IEA minimum. And the rate at which they can be released, let's just assume it's 1 million barrels a day, even though many experts struggle to see how that would be the case, because otherwise the releases that have taken place already in a strongly backward market would have seen the recipients of those SPR volumes draw down a lot harder. But let's give it 1 million anyway and include the European release in that. So you're from a loss of 2 point something, rounded up to 3, you've got 1 back from the SPRs. For the market to trade down as it has done, that's telling you that the market is expecting a demand loss, which is the solver for the rest of this, or a production increase from places like US shale of more than 2 million barrels per day in order for that picture to go into surplus and no longer running down, no longer tearing stocks. And that's a pretty big number. So where do you get that 2 million barrels per day? I'm just rounding now. Demand loss from? Well, there are parts of the world where rationing behaviors have already been in place. I mean, people have been balking at the high cost of natural gas for power generation, witness the high costs of coal, and in some cases, the decision to even start rationing and having rolling blackouts in various South Asian economies, for example. That's demand loss, right? We have evidence of people queuing for fuel in places like Southern Asia, but also in places like Eastern Africa. And again, you have consumer behavior being influenced in some way by Western European governments encouraging people to start thinking about some sort of rationing mindset. And there's some pretty big numbers available if everyone chooses to carpool or not drive to work 3 days a week or observe speed limits or whatever it might be, right? But it's still a pretty big number to get to. So the rest then has to be people's estimate of how much demand has been impacted in China. We already had in the price and in everyone's reckoning, everyone's balances, more than a week ago, the fact that domestic aviation demand for jet fuel in China was down to peak pandemic levels. So nobody's flying in China, right?
To get Mike's view on some of the logistic challenges here as well. Mike, we have a story in the digest today about ship fuel suppliers, bunker fuel, not allowing Russian vessels call into their ports. How big of a logistics challenge is that? Also, obviously, the issue of the ruble structure or not ruble, buying in rubles. Some of these structural impediments, even though there is no embargo as such.
Yes, the shipping sector is a relatively straightforward explanation. We have one large Russian shipping company, Sovcomflot, Sovchart, and they have been put on a sanctions list by various jurisdictions. And as such, people are a little bit hesitant or scared to supply them with bunkers or other services. So we will see that fleet out of circulation. That's the way it's heading. Of course, everything has a time lag in it. These sanctions don't take full effect after some time, and there are certain carve-outs to continue allowing European markets to be supplied because they can't get by without Russian energy. So if you take the big numbers, Russia exports about 7+ million barrels per day of both products, refined products and crude. And the figures I was giving you earlier is that maybe less than half of that is going to be shut in. So there are carve-outs, as Christian was alluding to before, for Europe to continue taking delivery of this. But yes, the shipping example is a pretty good one because you run into all sorts of issues, not just people providing fuel bunker suppliers, but also insurance companies and the banking sector, making it very difficult for people to effect payments to Russian shipping companies.
In Mike, when I'm not sure if you were in Lausanne last week or the week after when the community of traders were meeting, and one of the big narratives coming out of that was access to credit lines, and that there would be some real sort of disruption of maybe more vulnerable trading houses and so forth. What are your views on that? And again, like shipping, is that a structural? Is that there was some fairly alarming comments coming out of Lausanne on that issue?
I wasn't there, but I did follow some of it post facto online. Yes, there is a general acceptance that sanctions, which will be observed by all in those jurisdictions where they apply, will result in people winding down activity as they must.
Mike, your thoughts looking forward into the second quarter, into the coming weeks. Obviously, China is a big question mark on the demand side. Beyond COVID, there does also seem to be some real structural challenges there. The construction industry remains vulnerable, unresolved. Your thoughts on what might be bigger issues to watch going forward, and also welcome, you had commented, I remember a year or more ago, about when there was Iranian barrels leaking into the market, sanctioned barrels that were at a discount, that they were structurally dislocating the market a bit. If we see a lot of Russian oil in a similar place now going forward at such a big discount, how does that structurally impact the market?
Yeah, so much has been made about this. I mean, quick one on the ruble. I find it astonishing that the ruble is back to pretty much pre-invasion levels at 80 something to the dollar. Given the impact on the Russian economy, that just doesn't seem sustainable. But to your question, yes, I mean, that last point, allowing for carve-outs to Iranian sanctions, that has been done with the express input of the State Department, whereby a Chinese importer has the recognition that they won't be made subject to secondary sanctions or anything like that by continuing to buy a certain pre-agreed amount of Iranian oil. Over and above that, there is some leakage, which history of oil trading suggests is always the case in a world where sanctions apply. Now, the reason why there are sanctions on Russia are kind of different. I mean, Iran was sanctioned because of the concern over their nuclear ambitions and because of their sponsorship, allegedly, of state terror extraterritorially. Russia is being sanctioned for invading Ukraine. So I think the moral hazard argument, as we're putting it so much, is a global concern. And it's quite telling that Chinese buyers didn't step up to the plate, despite Beijing coming out the day after the invasion saying that it's business as usual with Russia. We haven't really seen particularly visible buying by China of Russian energy. Everyone's assuming it'll happen. Everyone's assuming there'll be a way found because there are no sanctions that prevent a Chinese energy consumer from procuring Russian supplies, provided they don't use the Western banking system or US dollars for payment. So
the Indians are doing it. The Indians are stepping in there.
And indeed, there's been various rapprochements there as well. Thanks. Yes. Sean, I missed your middle question now, which was
just about the outlook for China. The structural. Obviously, there's the COVID piece, which, as we've seen in most countries that have tried to tackle Omicron, it's a fool's gold, if you like. There's no way of Omicron not reaching its ultimate sort of outcome, which is spread everywhere.
Yes, I mean, Christoph mentioned the party congress in October. I think between now and then we're going to see China, and we have some anecdotal evidence on this already. Puts a massive effort into infrastructure spend and propping up of the economy in that very sector, which has caused the embarrassment to start with, the Evergrande, etc. So I think you're going to see big outlay. We've yet to see signs of major road building programs, but we're expecting it. We're yet to see signs of major infrastructure programs, but we are expecting it. And in the meantime, you've got apparently 20,000 Shanghai financial workers sleeping under their desks to make sure they can keep the wheels of commerce turning in China's financial capital. So no, I think China will throw the kitchen sink at making sure the economy delivers, despite the fact that you had a slightly negative set of PMI data just last week. They're not going to allow that economy to slow down too harshly before October. And yes, I happen to be in the camp of people that thinks that China will continue to suppress this, because I have staff in China who tell me real time what's happening. Got a few people in China, in Shanghai, they're all locked down. They've stocked up and they're going to go nowhere. And I've got a few staff that have been put on quarantine, and they get supplementary quarantine notices. And they speak to the authorities, and having returned from Singapore and quarantined for 3 weeks, they were asked to top it up, and they dutifully do so. So I mean, yes, you're right, Sean. Omicron is likely to spread everywhere at some point in time, but the Chinese are certainly making a good fist of arresting it.
But with that, I suppose at the cost of oil demand, we have earlier this week the idea that that oil imports into China will decline for the second year in a row. Would you still challenge that thesis?
They had a lot of inventory which they built. They were quite astute at taking advantage of the pandemic and building stocks phenomenally during 2020. So yes, if you want to say 2022 is the second year in a row, 2021 was certainly going to be less imports than 2020 because of that phenomenal stock build.
Right.
So that one doesn't really count. I think the jury's still out on this yet, because we have a long, long way to go. So I would not necessarily agree that we're going to see that second year running by the end of this year when we look back.